The global energy market is a complex and ever-changing landscape. For decades, the Organization of the Petroleum Exporting Countries, or OPEC, has been a major player, often holding sway over the price and availability of oil. This influence stems from the vast reserves controlled by its member nations, primarily located in the Middle East. The United States, once heavily reliant on foreign oil, has undergone a significant transformation in recent years. The shale revolution, which unlocked vast reserves of previously inaccessible oil and gas, propelled the U.S. to the forefront of global energy production. This newfound energy independence emboldened the U.S. and reshaped its geopolitical standing. However, the relationship between OPEC and the U.S. has always been one of delicate balance. OPEC's actions, driven by its own economic and strategic interests, directly impact the U.S. energy sector. This delicate dance has far-reaching consequences, influencing everything from petrol prices at the pump to the global balance of power. Any shift in this dynamic reverberates throughout the global economy. In a move that sent shockwaves through the energy world, OPEC recently announced a significant cut in oil production. This decision, a clear departure from recent trends, signals a new chapter in the global energy landscape. The motives behind this bold move are multifaceted. Some analysts point to a desire to bolster oil prices, which have been fluctuating in recent times. Others suggest that OPEC seeks to reassert its dominance in the global market, reminding the world of its enduring influence. This production cut has ignited intense speculation and debate among industry experts, policymakers, and consumers alike. The immediate impact is undeniable, with oil prices surging in response to the news. This volatility in the market underscores the profound influence OPEC continues to wield, despite the changing dynamics of global energy production. Across the Atlantic, the reverberations of OPEC's decision are keenly felt in the U.S. oil industry. After years of booming production and newfound energy independence, American oil producers now face a new reality. The sudden shift in market dynamics presents both challenges and opportunities for U.S. energy companies. The rising oil prices, while potentially beneficial for profit margins, also raise concerns about inflation and consumer spending. This intricate interplay of factors necessitates a strategic response from the U.S. energy sector. In the face of this evolving landscape, the U.S. must adapt and innovate to maintain its energy security and economic competitiveness. The immediate impact of OPEC's production cut reverberated through the U.S. oil industry, leaving producers at a crossroads. The surge in oil prices presented a tantalizing opportunity for increased profits, but it also came with a significant dose of uncertainty. Some companies, enticed by the prospect of higher revenues, contemplated ramping up production. This strategy, however, carried inherent risks. Increasing output too quickly could flood the market and drive prices back down, negating any potential gains. On the other hand, scaling back production in line with OPEC's move would undoubtedly impact the U.S. hard-won energy independence. The shale boom had transformed the nation into a global energy powerhouse, but this reliance on domestic production could now become a vulnerability. The delicate balance between maximizing profits and maintaining a steady hand in a volatile market became the central dilemma for U.S. oil producers. The impact of OPEC's decision wasn't confined to the boardrooms of energy giants. It rippled outwards, reaching the everyday lives of American consumers. As oil prices climbed, the cost of petrol at the pump followed suit, putting a strain on household budgets. The familiar sting of rising energy costs ignited debates about energy policy, affordability, and the long-term sustainability of the U.S. energy model. However, this price hike wasn't solely a cause for concern. For some segments of the U.S. economy, particularly those linked to domestic energy production, the rising tide of oil prices brought a wave of optimism. States heavily reliant on oil and gas extraction saw an opportunity for economic growth and job creation. This dichotomy of perspectives, with consumers feeling the pinch and producers eyeing potential gains, highlighted the complex and often conflicting interests at play in the energy sector. For U.S. shale producers, the situation was particularly complex. The shale revolution had been built on the promise of abundant and relatively inexpensive energy. However, shale extraction is a more costly process compared to traditional drilling methods. The fluctuating oil prices placed shale producers in a precarious position. While higher prices offered a much-needed boost to profit margins, they also brought back the specter of unprofitability that had haunted the industry in the past. The need to strike a delicate balance between capitalizing on the price surge and ensuring long-term viability became paramount. Companies with stronger balance sheets and more efficient operations were better positioned to weather the storm. However, smaller independent producers, often burdened with debt and higher operating costs, faced an uphill battle. This disparity underscored the inherent risks and rewards associated with the shale industry, particularly in times of market volatility. The future of the U.S. oil industry hung in the balance. Would OPEC's bold move trigger a new boom, propelling domestic production to even greater heights? Or would it expose the vulnerabilities of the shale revolution, leading to a potential bust? The answers to these questions remain shrouded in uncertainty, dependent on a complex interplay of factors. Global demand for oil, geopolitical tensions, technological advancements, and government policies would all play a crucial role in shaping the industry's trajectory. The stakes were high, with far-reaching implications for the U.S. economy, energy security, and the global balance of power. Part 3, Act 2. OPEC's production cut wasn't just an American problem, it was a global earthquake. The aftershocks were felt in capitals and stock exchanges across the world. Energy-hungry nations, particularly in Europe and Asia, watched with growing concern as oil prices climbed. The delicate balance of trade relationships shifted, with oil-importing countries facing increased costs and potential economic instability. The ripple effect extended beyond economics. Geopolitical tensions simmered as nations reliant on OPEC oil grappled with the implications. Some sought to strengthen ties with OPEC members, hoping to secure favorable deals and ensure a steady flow of crude. Others looked for alternative sources of energy, aiming to reduce their reliance on the cartel and diversify their energy portfolios. OPEC's move reignited a long-standing debate about energy security. For decades, the world had relied heavily on a handful of nations for its energy needs. This dependence, critics argued, made economies vulnerable to price shocks, supply disruptions, and geopolitical maneuvering. The current crisis brought a renewed sense of urgency to finding alternative solutions. Renewable energy sources, once seen as a distant promise, now took center stage. Governments and private investors alike poured resources into solar, wind, and other clean energy technologies, hoping to break free from the grip of fossil fuel dependence. OPEC's gambit created both winners and losers on the global stage. Some oil-producing nations, particularly those outside the cartel, saw an opportunity to capitalize on the shifting dynamics. With OPEC voluntarily limiting its output, these countries had a chance to increase their own market share and reap the rewards of higher prices. However, this shift in power came with its own set of challenges. Increased production brought with it environmental concerns and the need for significant investment in infrastructure and technology. The long-term sustainability of this newfound leverage remained an open question, dependent on factors beyond their control. Section 4, Beyond the Barrel. Is this the catalyst for a green energy shift? OPEC's production cut, while sending shockwaves through the global economy, might also prove to be a turning point in the transition to a cleaner, more sustainable energy future. The crisis served as a stark reminder of the inherent volatility and geopolitical risks associated with fossil fuel dependence. This realization spurred a renewed sense of urgency in the pursuit of alternative energy sources. The development and deployment of renewable energy technologies accelerated, driven by a combination of environmental concerns, economic incentives, and a desire for greater energy independence. While the transition wouldn't be easy or immediate, the seeds of change had been sown. Section 1. A time for Titans. U.S. oil giants chart a course. OPEC's decision sent shockwaves through America's oil giants. Executives huddled, faces lit by stock tickers. Titans of the U.S. oil industry faced a critical juncture. The old playbook needed a rapid rewrite. Responses mixed caution with opportunism. Some ramped up production to capitalize. Others took a more conservative approach, focusing on efficiency and strategic investments. Section 2. Diversification drive, hedging bets in an unpredictable market. OPEC's move served as a stark reminder of the inherent volatility of the oil market. For U.S. oil companies heavily invested in domestic production, diversification became the new mantra. The days of relying solely on the black gold beneath American soil were fading. A more nuanced approach was needed to navigate the uncertainties of the global energy landscape. Many companies began to hedge their bets, channeling profits from traditional oil and gas operations into a wider range of energy investments. Renewable energy, once viewed with skepticism by some in the industry, suddenly became a hot commodity. Solar, wind, and other clean energy technologies saw a surge in investment as oil companies sought to position themselves for a future where fossil fuels might play a less dominant role. The new reality of the energy market placed a premium on innovation. U.S. oil companies, facing a future shaped by both market forces and the growing urgency of climate change, realized that technological advancement was no longer optional. It was an existential imperative. The race was on to develop and deploy technologies that could extract oil and gas more efficiently, reduce environmental impact, and unlock new sources of energy. From artificial intelligence and automation to advanced robotics and data analytics, no stone was left unturned in the quest for a competitive edge. Companies poured resources into research and development, forging partnerships with tech startups and universities to tap into the latest breakthroughs. The goal was not just to survive the current upheaval, but to emerge as leaders in the energy landscape of the future, one where innovation and sustainability would be the keys to success. For decades, renewable energy sources like solar and wind played a supporting role, often overshadowed by the sheer scale and entrenched infrastructure of the fossil fuel industry. However, OPEC's audacious move, coupled with the growing urgency of climate change, acted as a powerful catalyst, propelling renewable energy into the spotlight. No longer a niche sector championed by environmentalists, renewables were now seen as a viable, even essential component of a balanced and sustainable energy future. Investment dollars, once flowing freely into oil and gas exploration, began to shift towards clean energy projects. Solar farms, once a rarity, sprouted across sun-drenched landscapes, their gleaming panels silently converting sunlight into electricity. Wind turbines, majestic giants with blades reaching for the sky, multiplied along coastlines and across open plains, harnessing the power of the wind. The energy landscape was changing, driven by a confluence of economic, environmental, and geopolitical factors. The transition to a more sustainable energy future wasn't without its challenges. The established order, built on decades of fossil fuel dominance, was being challenged by nimble startups and innovative technologies. Traditional energy companies facing a changing landscape had a choice to make: cling to the old ways or adapt and evolve. Many chose the latter, recognizing that the future belonged to those who embrace change. This period of transition fostered a unique blend of collaboration and competition. Oil and gas giants, leveraging their vast resources and expertise, formed strategic partnerships with renewable energy companies, investing in cutting-edge technologies and sharing knowledge. Startups, armed with disruptive ideas and a hunger to disrupt the status quo, pushed the boundaries of innovation, challenging the industry to think differently. The shift towards renewable energy wasn't just about technology, it was about people. The workforce, long reliant on jobs in the fossil fuel sector, faced a period of uncertainty and opportunity. The skills that had built the oil and gas industry, engineering, construction, logistics, were still in demand, but they needed to be adapted to the unique requirements of renewable energy. Governments, educational institutions, and private companies recognized the need for a skilled workforce and invested heavily in training and reskilling programs. Welders who once pieced together pipelines now found themselves assembling wind turbine towers. Electricians who had wired oil rigs now installed solar panels on rooftops. The transition wasn't always seamless, but it offered a chance for workers to be part of a cleaner, more sustainable future. The energy landscape, once dominated by a handful of powerful players and a single polluting fuel source, was evolving into something more diverse, dynamic, and sustainable. OPEC's bold move, while initially sending shockwaves through the global economy, had inadvertently accelerated this transition. The future of energy was no longer a distant vision, it was being built. One solar panel, one wind turbine, one technological breakthrough at a time. This new energy landscape was powered by innovation. Advanced battery storage technologies addressed the intermittent nature of solar and wind power, ensuring a reliable energy supply. Smart grids equipped with sensors and sophisticated software optimized energy distribution, reducing waste and enhancing efficiency. Electric vehicles, once a novelty, became commonplace, their batteries drawing power from a cleaner grid. The energy industry has always been a crucible of change. From the first gusher to modern shale technology, adaptability defines success in this dynamic sector. OPEC's recent moves are just one chapter in a story of innovation and competition. The U.S. oil industry, with its resilience, navigates these challenges. Companies that embrace adaptability will emerge stronger. This means adopting a long-term perspective, considering global energy dynamics and sustainability. It requires challenging conventional wisdom and fostering innovation. The energy landscape of the future will be far more nuanced and complex than the one we've grown accustomed to. The days of relying solely on a single dominant fuel source are fading, giving way to a more diverse and interconnected energy mix. This new paradigm will be shaped by a confluence of factors: technological advancements, geopolitical considerations, environmental imperatives, and evolving consumer preferences. In this dynamic environment, there will be no easy answers, no single path to success. Oil and gas, while facing increased competition from renewable sources, will continue to play a vital role in meeting global energy needs for the foreseeable future. However, their role will evolve, shifting from being the primary energy source to becoming one element within a broader energy portfolio. This transition presents both challenges and opportunities for traditional energy companies. Those that can adapt to this new reality, embracing innovation and diversification, will be best positioned to thrive. Despite the undeniable momentum behind the transition to cleaner energy sources, it's crucial to acknowledge the enduring allure of fossil fuels. Oil and gas, with their high energy density and established infrastructure, will continue to power economies and shape geopolitics for decades to come. The global thirst for energy, particularly in rapidly developing nations, shows no signs of abating. The challenge, then, is not to eliminate fossil fuels entirely, but to mitigate their negative impacts while ensuring access to affordable and reliable energy for all. This requires a multi-pronged approach, investing in carbon capture and storage technologies, promoting energy efficiency measures, and developing alternative transportation fuels. It also necessitates a global commitment to reducing greenhouse gas emissions and transitioning to a more sustainable energy future. The decisions made today by governments, businesses, and individuals will determine the course of the global energy landscape for generations to come. The stakes have never been higher. Climate change, driven by our reliance on fossil fuels, poses an existential threat, demanding urgent action. At the same time, ensuring access to affordable and reliable energy is crucial for economic development and improving living standards worldwide. Navigating this complex terrain requires a delicate balancing act, one that acknowledges the urgency of transitioning to cleaner energy sources, while recognizing the practical realities of our continued reliance on fossil fuels. It demands collaboration, innovation, and a shared commitment to finding solutions that benefit both present and future generations. The challenge is daunting, but the potential rewards, a cleaner, healthier, and more prosperous future, are well worth the effort.